people you know who have built quiet wealth, the ones with paid-off houses, real savings, money that produces more money while they sleep, almost none of them got there through some dramatic move. No lottery, no inheritance, no single brilliant investment. They got there through small habits, repeated every single day for 10 or 20 or 30 years. And here's the truth. The habits are not flashy. They wouldn't make a good seminar on their own. They wouldn't sell books. They're so simple that most ambitious people overlook them entirely, looking for something bigger and more impressive. The bigger and more impressive thing rarely shows up. The small daily habits, run for decades, are what actually produce the wealth. You see, most people in their 20s and 30s spend their financial attention on the wrong layer. They focus on the big moves, the career change, the side business, the big investment. Those moves can matter. But underneath them, running every single day, are 10 small habits that determine whether any of the big moves actually compound into wealth. Without the daily habits, the big moves leak right out of your life. With the daily habits, even modest income produces real wealth over decades. Listen, today I want to walk you through those 10 habits. None of them require advanced financial knowledge. None of them require high income. All of them can start tomorrow morning with whatever you currently have. And all of them, run consistently for 10 or 20 years, produce a financial life that the no-habit version of you could never have built. By the end of this talk, you'll have a clear list. 10 habits, each one small, each one available today. And the next 20 years of your financial life become the work of running them, quietly, every day. While almost everybody else is still looking for the bigger move that never quite arrives. Now, before we get into the 10, you must understand what life looks like when these habits are absent. Because most people in financial trouble are not lazy. They are not dumb. They are running their financial life without any of these daily habits in place. And the absence of the habits is what produces the trouble. Not the income, not the bad luck, not the unfair conditions. Here's the truth. I'm telling you, two people earning the same income with the same outside conditions end up in radically different financial places based almost entirely on what they did every single day with the money that passed through their hands. The one running the habits builds steadily. The one without them, no matter how much they earn, stays roughly broke. You see, this is one of the most ignored facts in financial life. Income isn't the variable that determines wealth. Daily money habits are. A person earning $50,000 a year running these 10 habits will retire wealthier than a person earning $200,000 a year without them. The math is not subtle. The math is brutal. And almost nobody believes it until they have lived long enough to watch it play out around them. But here's what most people in their 40s and 50s realize looking back. The years they spent earning more money without changing their daily habits did nothing for their long-term wealth. The raises went into a slightly nicer lifestyle. The bonuses went into a slightly bigger version of what they were already doing. The income increase produced spending increase, almost dollar for dollar, with nothing left over to compound. They earned more for a decade and were no closer to wealthy than when they started. You cannot build wealth on the big moves alone. The big moves, without the daily habits underneath, leak away. The promotion produces lifestyle inflation. The windfall produces a big purchase. The good year produces a slightly nicer life that costs slightly more next year. And the net result of all the visible financial wins over decades is roughly zero, because the habits underneath were not catching anything for the future. You must take this seriously, because most ambitious people are running this exact pattern right now. They are working hard on their income. They are not working on their daily habits. They will earn substantial money over their careers. They will not be wealthy at 60. The visible part of their financial life will look fine. The structural part, the part that actually produces wealth, will be missing. 10 habits, each one small, each one running every single day in the background of your life. Together, they form the structure that catches the income, compounds it, and turns earned money into actual wealth. Without them, the income just passes through. With them, the income builds something that lasts. Number one, you must install the habit of paying yourself first every single payday before any other dollar leaves your account. The automatic transfer happens the morning the paycheck lands. Not after the bills, not after the variable spending, not at the end of the month, if anything is left over. The morning of payday, before anything. You see, this is the single most important wealth habit in this entire list, because everything else compounds from the dollars you actually keep. And if you don't pay yourself first, you don't keep any. The money goes to bills, to spending, to whatever was easy to spend on. The savings that should have happened does not happen. Here's the truth. The order of operations matters. The same person with the same income and the same expenses ends up dramatically different over decades, based on whether they pay themselves first or last. The first payer accumulates. The last payer never quite gets to it year after year, even though they fully intended to. The fix is mechanical. You got to set up an automatic transfer that runs the morning of every payday. Some percentage, 10%, 15, 20, whatever you can sustain, moves automatically from your checking account to your savings or investment account. The transfer happens before you have time to think about it, before any spending happens, before the money feels like it belongs to your daily life. And what you'll find is that the rest of your spending naturally adjusts to the amount left after the transfer. The bills get paid. The needs get met. The discretionary spending finds its level. The savings that used to never happen now happens automatically every single payday without any willpower required. The habit runs in the background, building wealth while you go about your life. This is the habit on which all other wealth habits depend. Install it this week. Set up the automatic transfer. Watch what happens over the next year. The dollars you would have spent without noticing become the foundation of everything else this list builds. Next, track one financial number every single day. Just one. Net worth, savings rate, months of runway. Whatever number looked at daily gives you the truest picture of your financial position. The act of looking is the habit. The number itself is secondary. You see, most people don't know their actual financial position. They know roughly. They have a general sense, but they don't have a daily number that tells them this minute where they stand. And the absence of that number is what allows the slow drift away from where they wanted to be. Here's the truth. What you measure, you manage. What you ignore, drifts. The financial life that gets the daily attention is the financial life that improves. The one that gets ignored 90% of the time produces 90% unintended outcomes. The fix is to pick the one number that matters most to you right now. If you're trying to build wealth, track net worth weekly or monthly and savings rate daily. If you're trying to build runway, track months of expenses you have saved. If you're trying to pay off debt, track the debt balance daily as it decreases. Whatever number maps to your current financial focus, that number gets looked at every day. You have to do it daily. The looking takes 30 seconds. You open the relevant account, you see the number, you close it. No analysis, no agonizing, just the daily check. So the number stays in your awareness instead of fading into the background of your life. And what you'll find is that the daily attention causes the number to improve, not because of any specific decision. It's because being aware of it every day changes the small choices you make throughout each day. The lunch out, the impulse buy, the lifestyle creep. All of them get filtered automatically through your daily awareness of where you actually stand. The number becomes part of your decision-making instead of an abstraction you check once a year. Next, you gotta install the rule that when your income goes up, your spending does not go up to match the raise, the bonus, the new job at higher pay. None of those increases trigger an automatic increase in your lifestyle. The increase goes to savings and investment, not to a slightly bigger version of the life you were already living. You see, this is where most ambitious people lose every wealth gain they ever made. They earn more, they spend more. The gap between income and spending stays roughly the same, and the wealth never compounds. The lifestyle inflation pattern eats every income increase year after year, decade after decade. By 55, they're earning 4 times what they earned at 25, and they have basically the same net worth. Here's the truth. The first 100,000 a year and the second 100,000 a year have completely different effects on your wealth, depending on whether the lifestyle expands to absorb the second one. If your spending stays at the first 100 level, the second 100 goes entirely to wealth building. If your spending rises to absorb the second 100, you're working harder for the same financial outcome. The fix is to install the rule the next time your income rises. The first $10 of any raise you can spend. The remaining 90% goes to savings and investment. Not later, not after you've enjoyed the raise for a few months. Right away, automatically, in the same transfer mechanism you set up in habit 1. You must hold the lifestyle at the level you had before the raise. The raise itself becomes wealth building. And the strange thing is, you barely notice. The pre-raise lifestyle was already meeting your needs. The increment that would have gone to a slightly nicer car, a slightly nicer apartment, a slightly nicer set of indulgences. None of those would have made you meaningfully happier. They would have just inflated the baseline. Keep the baseline. Let the income increase go to wealth. Watch your net worth compound in a way that nobody around you running the lifestyle inflation pattern can match. Next, you have to install the discipline of buying the longer-lasting version of a thing when the math actually supports it. Not always. Not the most expensive option for its own sake. The version that, calculated over its actual lifespan, costs less per year of use than the cheaper option that wears out faster. You see, most people, when buying durable goods, buy the cheapest version that meets the immediate need. The car, the tools, the boots, the kitchen equipment, the furniture. The cheap version costs less today. It also lasts a fraction as long, breaks down more, costs more in repairs, and needs to be replaced sooner. Over the actual lifetime of ownership, the cheap version often costs more than the well-made version would have cost. Here's the truth. The math is not subtle over decades. A pair of boots that cost $150 and last 15 years costs $10 per year. A pair of boots that costs $40 and last 2 years costs $20 per year. The cheap boots are twice as expensive. Over a lifetime of buying boots, the difference is substantial. The rule applies to almost every durable good. The tool, the appliance, the vehicle, the furniture, the clothing. The well-made version, where it exists, is almost always cheaper per year of use than the cheap version that needs to be replaced repeatedly. The fix is to start running the calculation. You must run the calculation. Before any purchase of a durable item, you ask, what does this cost per year of expected use? You compare the cheap version and the well-made version on that metric. You buy whichever one costs less per year, accounting for repairs, replacements, and the time and energy of the replacement process. What you'll find is that the buy quality once approach saves substantial money over decades, while also producing a life surrounded by things that work, last, and continue to serve you. The cheap approach produces a life of constantly replacing things, which is more expensive and more annoying than just buying the well-made version once. Next, hold walking away money. The amount of savings that lets you say no to bad deals, bad jobs, bad housing, bad partnerships, bad anything. The money that gives you the option to walk away from situations that would have trapped a person without that cushion. You see, most people in their 20s and 30s accept terms they wouldn't accept if they had 3 months of expenses saved. The job that doesn't pay what they're worth. The apartment that's overpriced because they can't afford to be picky. The deal that has bad terms because they need it to close. The relationship dynamic they tolerate because they can't afford to start over. All of these accommodations happen because the walking away money isn't there. Here's the truth. The walking away money is one of the highest leverage financial assets you can hold. Not because of what it earns, because of what it lets you avoid. The bad deals you didn't take. The exploitative jobs you didn't accept. The desperate financial decisions you didn't make. The cumulative effect over a career of being able to walk away from bad situations is enormous. The fix is to build the cushion deliberately. You got to build the cushion deliberately. 3 months of expenses at first, then 6, then a year, eventually. The money sits in an account where it's accessible quickly, but not used for daily life. It functions mentally as your option to walk away. Every time a bad situation arises, you have the option. Most of the time, you don't need to use it. The option itself changes how you negotiate, how you respond, how willing you are to push back on terms that would have trapped the no-cushion version of you. This habit pays for itself many times over through the bad decisions you don't make. You cannot fake having walking away money. The cushion, once built, runs in the background of your financial life, quietly protecting every other decision from the desperation that produces bad ones. The version of you with walking away money makes better decisions than the version without it in every domain. Next, you got to treat every recurring monthly cost as a permanent decision, not a small monthly one. Because that small monthly subscription, that modest monthly service, that minor monthly fee, once installed, almost always continues for years, sometimes decades. The small monthly cost is actually a substantial multi-year financial commitment, dressed up to feel small. You see, this is one of the most clever traps in modern adult life. The monthly framing makes large total expenditures feel manageable. $30 a month doesn't sound like much. Over 10 years, it's $3,600. Over 20 years, $7,200. And most people sign up for these small monthly costs without ever doing the multi-year math, because the monthly number doesn't feel worth doing math on. Here's the truth. The cumulative effect of all your small monthly costs is enormous. Most adults are paying hundreds of dollars a month, sometimes more, in recurring fees they barely think about. Magazine subscriptions, service memberships, software they don't use, premium versions of things they hardly need, small fees that have been on auto pay for years without anybody examining them. The fix is to audit your recurring costs quarterly and treat any new recurring cost as a long-term commitment from the moment you sign up. Before adding any monthly cost to your life, you multiply by 120. That's the rough 10-year cost. If the 10-year cost still seems worth it, fine. If not, you don't sign up. The monthly framing has been bypassed. The actual cost is in view. You have to audit them all. Every existing recurring cost gets the same scrutiny. Once a quarter, you go through every recurring charge on your accounts. Most of them you've forgotten about. Some of them you'll cancel immediately. The cumulative savings over years of just keeping the recurring cost list tight is substantial. often $1,000 or $2,000 a year, all going to wealth building instead of services you weren't using anyway. The quarterly audit is 20 minutes of work. The annual savings are real. The compound effect over decades is enormous. Next, you must change what you buy with your discretionary money. You cannot build wealth on toys alone. Most people, with their leftover dollars, buy things that cost more money to maintain. The boat, the bigger house, the second car, the toys. Wealth builders with the same dollars buy things that produce more money. The small investment, the rental property, the piece of a business, the asset that throws off income. You see, the difference between an expense-producing asset and an income-producing asset is one of the largest financial distinctions in adult life. The boat costs you money every year. The boat doesn't make money. Over a decade of boat ownership, the cumulative expense is substantial, and at the end, the boat is worth less than when you bought it. The same dollars put into an income-producing asset would have produced money every year. At the end of the decade, the asset would have grown in value and would have paid you income along the way. The two paths, starting from the same dollars, end up worlds apart. Here's the truth. I am telling you, the wealth builders you know are not necessarily living more frugally than you. They are spending their discretionary dollars on different categories. Their fun money goes into things that compound. Yours goes into things that depreciate. Same effort to earn the dollars. Wildly different consequence of how the dollars get deployed. The fix is to start running every significant discretionary purchase through the question: does this produce income, or does this require money to maintain? You got to shift the default. You can still buy some expense-producing things. You don't have to live like a monk. But the default category gets shifted deliberately toward income-producing assets. The expense-producing toys become the rare exception, not the default purchase. Over a decade of running this filter, your asset base looks completely different from the asset base of somebody running the default expense purchase pattern. And the income from the assets you've accumulated starts to be substantial, paying for some of the things you used to have to work hourly for. Next, you have to install a 30-day pause on every non-essential purchase over a chosen dollar threshold. You must pick a threshold that matches your income. For some people, it's $100. For others, $200 or $500. The exact number matters less than the practice. Any non-essential purchase above the threshold waits 30 days before you decide. You see, the impulse purchase is one of the largest single drains on adult financial life. Not the necessities, not the planned purchases. The impulse, the thing you saw, wanted, and bought within an hour of first encountering it. Multiplied across years, the impulse purchases add up to thousands of dollars per year for most adults. Most of it on things they barely use a year later. Let me tell you about a man I once knew. He was in his mid-30s, decent income. He had a chronic problem with impulse buying. Small electronics, tools, gadgets, gear for hobbies he had only mildly interested himself in. Every year, several $1,000s of his money went into things that sat in closets and basements within months. He installed the 30-day rule. Any non-essential purchase over $200 waited a full month, no exceptions. He could put the item on a list. He could think about it. He could research it. He just could not buy it for 30 days from the moment he first wanted it. The first month, he wanted 3 things. By the end of the month, he had forgotten one entirely. He had decided another wasn't worth it. One survived the wait, a tool he genuinely needed for a project he had actually been working on for months. He bought that one. He skipped the other 2. The pattern repeated. Over the first year of running the rule, he wanted approximately 30 things he would have bought immediately under his old pattern. He ended up buying about 8 of them. 22 items, which he would have purchased under the old default, faded out during the 30-day wait. They had been impulses, not real needs. The wait revealed which was which. The financial impact was substantial. He estimated saving roughly $5,000 in the first year compared to his previous spending pattern. The money went into the investment account he had set up under Habit 1. Over decades, the compounded effect of those redirected dollars would be 6 figures. But the more interesting effect was psychological. His satisfaction with the things he did buy went up because each purchase had survived the 30-day test. Each one was actually wanted, actually needed, actually used. The relationship he had with his belongings became cleaner. Less stuff sitting unused. More of what he owned actually being used regularly. He told me a couple of years in, the 30-day rule was the most powerful financial habit I ever installed. Not because of any single decision it changed, because of the thousands of small decisions it filtered over years that I would have made impulsively otherwise. The wait was the entire technology. Not budgeting, not restriction, just time between the impulse and the purchase. You can install the same rule tomorrow. Pick your threshold. Run the rule for a year. Watch what happens to both your spending and your relationship with what you actually own. Next, install the rule that every windfall, every bonus, every tax refund, every unexpected check, every dollar that arrives outside your regular income defaults to investment, not lifestyle. The windfall does not become a vacation, doesn't become a purchase, doesn't become a celebration. It goes by default into the wealth-building accounts. You see, most people treat windfalls as license to spend. The bonus comes, and immediately the brain starts shopping. The tax refund arrives, and the vacation gets booked. The unexpected check feels like permission to do something special. And so the windfall, which could have substantially accelerated wealth building, becomes a slightly nicer week. Here's the truth. Windfalls are some of the highest leverage moments in your financial life. They are dollars that arrive outside your normal spending patterns. They could have produced enormous compounding if deployed into wealth-building assets. Instead, almost all of them get spent on lifestyle items that disappear within weeks. The fix is to install the default. Every windfall goes to investment automatically. The moment it arrives, you don't even think about it. The dollars get deposited, you check the new balance, you move on. The windfall has been captured for the long term. You must apply the default first. If you want to spend some of it, you can, but only after the default has been applied. Maybe 10% of any windfall is available for lifestyle. 90% goes to wealth. The split is automatic. The dollars are deployed before the brain has time to negotiate. Over a career, the windfalls add up to substantial money. Bonuses across decades, tax refunds across decades, inheritances, small business sales, unexpected returns. All of them, captured into the wealth building system, produce a meaningful chunk of long-term wealth. Often more than the regular saving habit produces, because windfalls are larger lumps that compound aggressively. You got to capture them differently. Most people lose all of this potential by treating windfalls as spending money. You can choose differently, starting with the next windfall that arrives. The default has been set. The dollars know where to go. Next, you must spend daily attention on growing your income, not just managing your expenses, because the expense side has a floor. There's only so much you can cut. The income side has no ceiling, and the wealth builders you know are spending most of their financial attention on growing what comes in, not just on managing what goes out. You see, the personal finance industry overwhelmingly focuses on the expense side. Budget, cut spending, track every dollar. The advice is fine as far as it goes. But the expense side, optimized perfectly, can only do so much. Once you've cut out the waste and run a tight household, Further cuts produce diminishing returns and start hurting your quality of life. Here's the truth. The income side is where the leverage actually is. A 10% increase in income with stable expenses produces dramatically more wealth building capacity than a 10% cut in expenses with stable income. And the income side is much more elastic than most people realize. With deliberate daily attention, your income can be significantly higher in 5 years than it is now in almost any field. The habit is to spend at least some financial attention every day on the income side. Asking, how could I be earning more? What skill, if I built it, would let me charge more? What side income could I install? What raise should I be negotiating? What career move would substantially increase my earning capacity? The questions are deliberate. The attention is daily. The answers, accumulated over years, produce a substantially higher income than the no attention version of you would have. And the income increase captured into the wealth building habits from this list becomes wealth at a rate that the expense-only approach could never match. I'm telling you, the combination, growing income plus disciplined expense and savings habits, is what produces wealth in adults of average income. Either one alone is much weaker than both together. Daily attention on the income side. As deliberate as the daily attention on the expense side, the combination is what builds the financial life you actually want. Listen, so here's what I want you to carry with you. 10 habits, each one small, each one available starting tomorrow. None of them require advanced knowledge. None of them require high income. All of them run consistently for decades, build the kind of wealth that the no-habit version of you could never have built. Pay yourself first the morning of payday. Track one financial number daily. Refuse lifestyle inflation when income rises. Buy the longer-lasting version when math supports it. Hold walking away money. Treat every recurring cost as a permanent decision. Buy income-producing assets, not expense-producing toys. Install a 30-day pause on non-essential purchases over a threshold. Default every windfall to investment. Spend daily attention on the income side. And you must pick 3 to start. The 3 that hit hardest when you heard them. You must install those 3 this week. Run them for a month. Then add 3 more. By the end of 2 months, you've got 6 running. By the end of 3 months, all 10. The integration is gradual. The compounding starts the moment you start running them. Here's the truth. Wealth is not luck. Wealth is not inheritance. Wealth is not the result of a single brilliant move. Wealth is the cumulative product of small daily habits run for decades by ordinary people of ordinary income. The wealth builders you know are not smarter than you. They are running these habits day after day, while everybody else is looking for something bigger. I'm telling you, this is one of the most underrated truths in adult financial life. Most people will spend the next 30 years looking for the big move that builds wealth. The few who don't, who install these small daily habits and let the math do its work, produce financial lives that the big move chasers could never have produced. You can be one of those few, starting tomorrow, with 3 of the 10 habits installed. By month 3, all of them running. By year 5, your financial trajectory is noticeably different from where it was. By year 20, the difference is enormous. By year 40, the difference is the difference between wealthy and broke. The habits are small. The years are what they are regardless. The compounding is yours to claim. Claim it, starting this week. With 3 habits chosen tonight, and then keep running them quietly every single day for the decades that follow.